We're going to talk today about the importance of having a life insurance policy if you have to pay child or spousal support, as well as what happens with your medical insurance once you separate from your spouse. My name is Bev Lewis, and I'm the president and founder of Positive Solutions Divorce Services, where we help separating couples save unnecessary legal fees, and we guide our clients step by step through the divorce process. Today, I'm thrilled to have with me Aviva Abraham. Aviva is a benefits and insurance specialist with the Creative Planning Financial Group. And Aviva's been with them for since 2010, I believe. Yes. So welcome, Aviva. I'm happy to have you join us today.
Thank you. Great to be here.
Yeah. So I do divorce mediation. So I help couples put separation agreements together so that they don't have to go through the adversarial court process and spend thousands upon thousands of dollars in legal fees and quite a time-consuming process. So in the separation agreement that we draft, that we help our clients to draft, there's a section with respect to child and spousal support. So right. There's sometimes that if a couple is separating and they have children, or not children in the case of spousal support, that there may be one of the spouses with the higher income has to pay out support on a monthly basis right. to the person that has a lower income. Okay, one of the situations that come up in the separation agreement is the life insurance portion in order to secure the child support. Right. So what that is, and I'm gonna have you talk on this a little bit, but what that is in the separation agreement is that if I am paying to my spouse child or spousal support and I die, then my ex-spouse needs to have some security with respect to the income that they would be receiving if I was still alive. Right. So can you just talk a little bit about that and kind of what the importance of that is and what you can offer through your company?
Sure. So first of all, as you said, the courts actually obligate one of the parties, or sometimes both of the parties, to take out a life insurance policy because they deem those parties to be obligated, even after they pass away, obligated to provide that financial support. So if somebody were to die early, die unexpectedly, and they were supposed to pay out another 10 years of either child support or spousal support, the court knows that that other party or the child would now be suffering financially because of that. And an easy way to make sure that there isn't a financial hardship is through insurance. And so they obligate, aside from the support payments, to also take out an insurance policy for that period of time that the obligation exists, to make sure that even if the person that's paying passes away, the surviving spouse and or ex-spouse and the child would still have the money that they need and that they were expecting.
Right. And how hard is it for somebody to get a life insurance policy if they've never had one before?
So these days, it's actually easier than ever before. Even, well, if you're healthy, first of all, they're actually requiring fewer medical exams. They're making it easier for people to get term rates, which means the less expensive type of insurance that is what a lot of younger people take, have gone down in the last 5-10 years, so it's quite inexpensive. And if somebody is hard to insure for whatever reason, they have a health issue or family history, there are companies that have come out now with policies that are specifically designed for hard to insure clients that will ask them medical questions, but not very, very detailed. They will give them only a limited amount, so you can't get $1 million, but you can maybe get $300,000 or $500,000, depending on the company, depending on the issue that you have. And they will ask you to pay a little bit more than standard rates, but it's not ridiculously expensive. So there are definitely options for people to have these days if they need to secure life insurance for their spousal support.
So somebody that has a child that may be, let's say, 5 years old, and they have to pay child support for that child for until that child is 18, you're looking at a 13-year policy.
Right.
So that's not, you wouldn't recommend necessarily a term 10 policy. You would probably recommend a term 20 policy.
Either a term 15 or a term 20,
policy.
definitely.
Okay.
There's actually 1 or 2 companies that allow you to pick and choose the specific number of years.
Oh, okay.
But again, it depends on your situation. If you're a female, how old you are, male. Sometimes a term 15 would be just about the same price as picking that 13-year. Sometimes it's significantly cheaper.
Because I often have clients that come in that have joint policies. So how would that continue, or would it continue, after a couple go through a separation and divorce?
Okay, so first of all, one of the recommendations I make to clients is that whatever you have while you're going through divorce, speak to a financial advisor before you decide to make any changes to it. For sure, don't cancel anything, because it is a stressful time. There are a lot of changes. I've had people that have canceled things for whatever reason. Sometimes it was budgetary. They didn't want to have to pay out that amount, or they were cutting back on expenses. But always review with your financial advisor. If you do have a joint policy, it would need to be a joint and first to die policy to help with the financial obligation of support. And what that means is, when there's a joint policy, that means there are 2 insureds on that policy. So there's 1 payout and 2 people that have been underwritten and have been assessed by the insurance company. If it's a joint and first to die policy, then that insurance policy would pay out on the first death, which is what is needed for a support obligation. A joint and last to die policy is what people usually take out for estate planning purposes.
Right.
So always good to speak with a financial advisor before making any changes. But if you do have a policy, you can use that for your insurance obligation, for your spousal obligation. The question is it the right fit for you? So if you have a joint and last to die policy, that doesn't really help for spousal or child support obligation, because that will only pay out after the second person passes away.
Okay.
What people have done is they've taken a joint and first to die policy, or if somebody has a joint and first to die policy, they can use that. And what that means is the insurance company will have 1 payout, as opposed to 2 separate policies on 2 separate people. There are 2 payouts. So a joint and first to die policy, there's 1 payout based upon 2 people's lives, so whichever person dies first. There's only 1 premium, and what people do at that time is they will split the cost so that it is a less expensive option sometimes for people. If you've got a couple where one person is a lot younger, the other person is quite a bit older, or is a smoker, so the rates would be higher, sometimes a joint and first to die policy would not be a good option, because it's not going to really save money for the person that's a non-smoker or much younger. But it really depends on the 2 parties and how they want to work it out. So again, we assess every situation and what would be the best option for them. 2 separate policies, or if they have a joint and first to die policy already, that might be a better option for them.
Okay. So talk to me a little bit about beneficiaries. What does that mean? What is a beneficiary, and why is it important in the context of going through a separation and divorce and having to maintain a life insurance policy for child and spousal support?
So one of the main benefits that an insurance policy has is that it pays out directly to a beneficiary. And a beneficiary is a named person that the insurance company pays the proceeds out to. So if somebody, let's say, has a $250,000 life insurance policy, when that person passes away, the named beneficiary on that policy will get that money, and it bypasses the courts, it bypasses the estate, and it gets paid out a lot faster and tax-free, which is a huge benefit for the beneficiary and for the family. Usually people will sign what's called a revocable beneficiary. That means the owner of the policy can change the name of the beneficiary at any time that they want. So if they want it to be their spouse, they can make it their spouse. If they divorce, they can change it to make it a sister or a child. But they have the right to make that change because they're the owner on the policy. When it comes to life insurance and securing life insurance for spousal or child support, you need to name an irrevocable beneficiary. That means that you cannot change it. The owner cannot change the beneficiary without getting the signature of the irrevocable beneficiary and the approval of the irrevocable beneficiary. Because if they don't sign an irrevocable beneficiary, then the person can take out a life insurance policy and tell their ex-spouse, yes, here's the life insurance policy, and then go a month later and just change the beneficiary, and the beneficiary would never know. Like, they're not notified. If it's a revocable beneficiary, they're not notified. By making the person an irrevocable beneficiary, there are no major changes to the policy that can be made without the irrevocable beneficiary being notified. So whether it's a change in banking for most companies, if it's a change in the amount, if it's in the change of type of coverage, and for a missed payment. So if there's a missed payment, the irrevocable beneficiary would be notified. And then this way they can take steps to make sure that that policy will not lapse because of non-payment.
Okay.
So that's why the courts mandate that an ex-spouse or whoever needs to be named irrevocable beneficiary is put on in that way.
So when drafting up a separation agreement, clients need to have life insurance to secure child and spousal support. So if they're paying child or spousal support to their ex-spouse, then that person needs to have an irrevocable life insurance policy with the beneficiary as the ex-spouse.
Right.
Correct.
Right.
Okay. Okay. So then let's talk a little bit about medical benefits.
Okay.
Because when a couple is together, usually one party, usually the working spouse, if it's not a if there's let's say a stay-at-home mom and then the husband is out working outside of the home, the husband may have medical and dental benefits through their employer.
Right.
Wife may not have any benefits, so she is on the family plan that the husband has. So when they go through a separation, oftentimes the employer will say, you are now separated or divorced in most cases, so your spouse is no longer allowed to have to be on that plan. Your children can still be on the plan, but your ex-spouse may not be. So what happens in that case? What do you recommend in those situations for the person that's no longer able to get medical and dental benefits? So
that is a big issue today. If the working spouse and the one that's paying the support does have a group plan, generally group plans are very, very comprehensive coverage and something that the ex-spouse cannot get on her own through an individual health plan. So you can get an individual health plan, but it's very, very limited in coverage. And the biggest risk today is needing high-cost medications. So I always recommend to clients that are going through separation and divorce to discuss what will happen when that ex-spouse no longer has coverage, because she will have to pay for an individual policy now for health and dental benefits if she needs coverage. B, if she has health issues, or even if she doesn't have health issues now, but health issues can develop, that could be thousands and thousands of dollars, and that's something that needs to be discussed and accounted for and dealt with during the divorce process.
Right, right.
If any of those, whether it's the person paying support or the ex-spouse has a business, there are more options. If the person is self-employed, there are some better options than individual health and dental benefits that a person can get that would give them some protection in terms of healthcare coverage. But if the person's not self-employed, their options are more limited.
Yeah.
But it is something that should be discussed and dealt with.
So again, when drafting the separation agreement, you need to be very clear on what's going to happen moving forward, whether that's help in paying for some of those premiums, or in some cases for religious reasons or for health reasons too. People are just not getting a divorce. They're separating but not getting a divorce, so they can stay on their spouse's medical policy, but it really needs to be laid out in a separation agreement how that's all going to take place moving forward.
That would be the best course of action.
Yeah.
Definitely.
Yeah. So what kind of products or suppliers would you have for medical benefits for couples, for a spouse that is no longer on the other spouse's medical plan? So
it would be very good if they're proactive and discussing this, because when the ex-spouse is taken off the plan, there are actually some additional options available in terms of being able to get a little bit better plan when it comes to individual coverage. So there are two types of coverage, individual and group. Group is what's offered through an employer. Individual is whether the person is not working, does not have an employer, or they work at a company that does not offer benefits. Then they need to take an individual plan. And there are more basic plans. There are plans where you don't have to answer medical questions. There are plans where you do answer medical questions, but then they will exclude any existing medication. So there are a lot of things to be aware of. But when someone was on a group plan and either they left their employer or they're now no longer on their spouse's plan, so they're leaving a group plan, there is something that all of the top companies, Great-West Life, Manulife, Sun Life, offer continued coverage, but at a more limited, on a more limited basis, but still better than if you would have to answer medical questions. So they know if somebody's already taking a medication and has to answer medical questions, they would be excluded from having that coverage. So in order to provide for someone that was used to getting a group plan and can no longer qualify for the group plan and can't qualify for a better individual plan, there is this, it's called Follow Me type of plan that they can get as long as they apply within 30 to 60 days of losing their group coverage. So it's very important to be time sensitive when going for your medical care. If someone is self-employed, they have a few more options. If they have one or two employees, they can sign up or get their own group plan, which would provide them the most flexibility and best type of coverage. If they don't have any employees, there's still other ways to sort of cover off the biggest risk of drug coverage if they're already, if they don't already have a big need. So somebody who is already sick, they would be more limited. But if somebody is just on some minor medication, but they're at risk, like the biggest risk today, if somebody's younger than 65, is not really dying. The bigger risk is getting sick and needing high-cost medications, which could run tens of thousands of dollars. For cancer, it could run over $100,000. So that is something that needs to be protected, even if they don't have that need right now, but it is a real risk going forward and as we age.
Right, right.
I had a client that every year he went to his ex-spouse, and every year he reduced that life insurance policy by the amount of the annual obligation, because he didn't want to pay that extra amount. A lot of people won't go every year and go through the hassle of doing that. Because again, it depends. Is it $10 a month that you're really saving? Is it $20 a month? It's still going to your child, so a lot of people just leave it for 2-3 years before reducing it. And you don't have to ever reduce it, but if you want to, you have that right to reduce it, reduce the life insurance coverage, and then that would reduce your costs as well.
Right.
And then at the end of the 10 years, you can choose what you'd like to do. You can keep that policy. You can convert that policy to permanent insurance. You can change the beneficiary. You can change the type of coverage, and you can cancel it totally if you want.
And I have some clients that have more life insurance than what they're obligated to have for child and spousal support purposes, but they only make that portion of the life insurance policy the other person as the beneficiary. So if they have a $500,000 policy, they really only have to have $100,000 for child and spousal support calculation for purposes. Then the other $400,000 they can send to whoever they want as the beneficiary.
Yes. So they can definitely allocate and designate a portion of that as irrevocable beneficiary to the ex-spouse. The other part of the policy would stay to whatever would be allowed to designate a beneficiary, any other beneficiary that they want.
Right, right. Well, that was wonderful information. Thank you so much for joining me today, Aviva.
Thank you for having me.
Really appreciate having the conversation and teaching our viewers a little bit more about life insurance and medical benefits after they go through their separation and divorce. Thank you so much.
Thank you.
Yeah.